Hi guys, welcome to Rubber Capital YouTube channel, and in today's video we'll be looking at supply and demand trading strategy, the ultimate guide, all you need to know about supply and demand. And in this video we are going to look at what are supply and demand zones, price imbalances and price efficiency, types of supply and demand, continuation and reversal, which are the types, and we have the rally based rally, drop based drop, rally based drop, drop based rally. And also we are going to look at how to identify a supply and demand zone and how to trade supply and demand strategy. But before I continue, if you are new to this channel and you are yet to subscribe, kindly hit the subscribe button, like, and smash the notification button so that whenever I release a new video just like this, you'll be the first to be notified. Okay, so let's move on. What is supply and demand? Supply is the total quantity of an asset a seller is willing and able to sell at a particular price in time. When the price increases, the supply increases because the seller is willing and able to sell more. Okay, and when price decreases, the supply decreases. Demand is the total number of quantity a buyer is willing and able to buy at a particular price at a point in time. When price increases, demand decreases, and when price decreases, demand increases. Now, how do we relate this to the forex market? Because you are not in economics class. Okay, in the forex market, supply and demand plays a vital role when it comes to making profitable trades in your forex career. And as is our duty as traders to identify areas of supply and demand. These are simply areas where supply was introduced into the market, where orders were filled, and then a sharp move either upward or downward. When order comes in and there is a sharp move down, means at that place where there was distribution of orders, we can call that area what? A supply zone. Same thing with the demand zone. Price was low, then there was accumulation of orders before the sharp move. Now, the zone before that sharp move is the demand zone. I will explain more in details. Okay, let's move to the next slide. Now, the supply and demand zone, how do we identify them? I will say supply are simply area of distribution, okay, where orders were filled that takes price to the downside. Remember, or as I said, area of distribution are simply areas of what? Of manipulation. Prices was what? The market was manipulated, okay, to take out the weak hands in order to move the price downward. Now that means you sell at a area of what? Premium, and you buy at area of what? Discount. Demand zone on the other hand are simply area of what? Accumulation, where orders came in to push the price to the upside. Areas of accumulation taking price to the upside, that is the demand zone. Okay, and we can identify some of them here. How do we identify area of demand zone? But before I do that, let's quickly look at one thing. Price imbalances. Whenever supply and demand is introduced into the market, it creates imbalances on the move, either upward or downwards. Okay, but first of all, let's look at price efficiency. Now, we say that the price is efficient if we have a situation like this: a three candles. Okay, in this case, the example I choose here is a down candle. It can also apply to an up candle. Okay, because of time, I will only illustrate on the downside, on the sell side. Okay, we have three candles here. What do you notice? The wick between this first and the third candle, okay, the wick between them touches and even crosses one another. Okay, crosses and touches one another. there's no gap in between them, there's no space. So by so doing, this is an efficient price and price efficiency. But price imbalance, on the other hand, when you look at the two candles, the first and the third candle, we notice that there is a gap between the first candle and the second candle wick. This area of gap is simply what? An imbalance that was created. And in the methodology which I trade, which is the smart money concept, we expect price to come up in here to fill up this gap. This is what they call liquidity void. Okay, some people call it liquidity void, some call it what? Price imbalance. Okay, we expect price to come in here. So whenever you see a supply has been introduced, most times it creates an imbalance. That is how you identify if that zone was actually a supply zone or not. Okay, so I believe you understand that. Now, types of supply and demand. Okay, we have different types of supply and demand zones or pattern. We can divide them into two: the continuation and the reversal pattern. Okay, if you're a trend follower, you'll be expecting to look for this pattern here, so that you can jump back into the trend and ride the wave upward or downward. Now, for a bullish market, we have the rally-based rally, meaning a push up, a consolidation, and another push up, a leg up, consolidation, leg up. For a downward market, we have a drop-based drop, a drop, leg down, consolidation, leg down, drop, based drop. Now, don't be fooled with being 3 candles. It can be more than 3 candles. Okay, the leg up could be 1, 2, 3, or even 4 candles. The base here could be 1, 2, or even 4 candles. Are you with me? Same thing with the leg up. But in a nutshell, we will simply use a up, a down, a up, a consolidation, and up. Like in this case here, price move up, consolidate here. This consolidation is the base. The consolidation there is the base. Okay, the consolidation here is the base. Okay, so in this case we have a rally, a base consolidation rally. Okay, rally base rally. Now for the reversal pattern, okay, we have a leg down, a base, and a leg up, which is drop base rally, drop base rally. So as I said, it's not limited to just 3 candles. We can have several candles coming in there, forming what? A consolidation. The consolidation can also be more than 1. It can be 2, 3, 4, 5. Okay. Then after the consolidation, we now have a reversal to the upside, which is a leg up, and it could be 1 candle, 2 candle, 3 candle, and so on. So once you identify that, you know that this area here, the base is what we are interested in. Okay, the base here is what I call our point of interest. Point of interest. As a demand or supply trader, we are interested in the base. Okay, in the base. So we expect price to come back to the base to take the price upward. For a rally-based rally, we expect price to come down into this base. Once it touches this base, we expect it to what? To continue. Continuation pattern. We have an up move, price retraces into this base, then continue. That is our expectation. For a reversal, we have a down move and a up move. And now we expect price to come back in here, test this demand zone, then move the price upward. Same thing with the rally based rally. Okay, we have a leg up, a consolidation, and a leg down. So what are we expecting as traders? We are expecting price to come back into the base, which is our point of what? Interest. Take note, point of interest, so that we decide to know if we are to take this trade or not. Okay, And as I said, it's not limited to just 3 candles. You can have several candles forming this pattern. Okay, what you need to look at is simply a drop, a base, which is the consolidation, then a rally. So we anticipate price to come back into this base. We anticipate price to come back into this base. Okay, to come back into this base, then we enter the trade to take the price up. Okay, that's all to it. Okay, and how do we identify a supply and demand zone? Very important. So let's come back to our chart here. In this case, I can see one demand zone here and supply zone here. Okay, why is it a supply zone? The 3 candles here, when price move, you can see a sharp move in price, creating imbalances. There's an imbalance here, there's an imbalance here. So that means this is a supply zone. There was orders in here in this monthly chart. There was orders in here that was filled, manipulated the highs, break structure to the downside, then move the price downward, creating a point of what? Supply. So when price trade back in here, we expect to look for a short. Okay, another supply zone is this. We have this another supply zone here. Even though this was traded through, but eventually it came down. Okay, this is a supply zone. Why? It created an imbalance. Can you see? There's an imbalance here. It created an imbalance. Okay, then move the price downward. So our aim as trader is to wait for price to come in here. Okay, and take the price downward. We also have another supply zone here. There are so many on the chart, but is it all you will be trading? No. With time, I will create more videos to help you identify the best or the best supply and demand zone. Okay, now those are supply zone. We have the demand zone here. Why is it the demand zone? There was consolidation. You can see we have 3 candles in here. There was consolidation here that pushed price upward. Okay, creating what is called imbalance. You can see all this imbalance. When it moved, price have to come back in. In this case, we have, if we are taking this trade, we have a beautiful what trade setup. Price came in here and take price upward. That is how to identify. You identify by doing one thing, 3 things. Look at the current price. Okay, let me see if I can come to a lower. Look at the current price. If the zone, what has happened here? 1 minute, please. Sorry, there was a glitch somewhere, but let's move on. What we need to do is to look at the current price. Like in this case, this is the current price. If I'm to identify a demand zone, for example, I will look left. Okay, I will look left and identify a zone that price hasn't touched. Are you with me? Identify a zone that price hasn't touched. Let's go to daily. So in this case, I can see a demand zone here. Why is it a demand zone? Because it is below the current price. It is below the current price. When you identify the current price, then you look left to your chart, identify area of what demand, where there was a sharp move that created an imbalance. You can see this is a sharp move that created an imbalance here. So we can say this is a demand zone. Okay, supply zone on the other hand is you look at the current price and then look above to the left. Look for area where there was a sharp move in price after the consolidation that created an imbalance. Okay, those are the key things. Very easy. In this case, there was imbalance here, so this is a supply zone that we can trade in the future. If price eventually come in here, we'll be looking to short the market. This is demand zone, is always below the price. The price come in here, we expect it to what? To go upward. Now, how do we identify Like this case here, this is a drop base rally, drop base, drop base rally. Right? Another one here, drop base rally. Are you with me? For a continuation, this a drop, a base, all these are base, then a drop base, drop formation. Okay, same thing with this. We have a drop, this is a base. You can see there's an imbalance here, drop base drop. Okay, so that is how to identify a supply and demand zone. The last slide here is how do we trade, how to trade supply and demand strategy. There are two approaches to this. We have the high risk approach, and we have the confirmation approach. Remember, our base is what we call the point of what? Interest, POI, or area of interest. Okay, whatever name you want to give to it, doesn't matter. What matters is your understanding of how the strategy works. Okay, now let's assume you have a rally, base, and another rally here, for example, and a rally, base, a rally. How do we trade this? We are trading this when price comes back in here. Okay, now this scenario here is the risk method, which I will explain, and this one is the confirmation method. Now when price comes back in here, the moment it enters the zone, we pull the trigger. We are going to sell this. Okay, and we are going to buy, because this is a demand zone. Okay, we are going to buy this from the beginning of the base, then our stop loss will be below the base. Then we expect price to go up and hit our what? Take profit. Our first take profit could be at the point of reversal up here. Can decide to target that. Now this approach is risky because price can come to this place and then continue going down, hitting your stop loss. So I chose a wrong this thing. We are looking for long. Okay, good. Your stop loss will be below here, then take profit will be up for. Are you with me? Now the disadvantage of a high risk approach is that number one is risky because there is no form of confirmation, and secondly, the risk to reward is always smaller compared to the confirmation approach. The risk to reward in this case is smaller compared to this. I will explain why with this illustration. Now let's assume we have the same scenario here. A rally, base, rally. Okay, price comes in, consolidate, then we expect price to come back into the base. Remember, this is our base. Okay, let me make it clearer. Okay, now this is the consolidation. Price consolidate here before taking price upward. Okay, same thing here. Price comes in here, then start consolidating, then move upward. Now what this consolidation is what we're interested in, because this is where demand and supply was introduced. In this case, demand was introduced in this consolidated area. So whenever price comes into this area, we look for a buy. Now this is how to trade this using the confirmation approach. We wait for price to come in here this way, comes into the zone. Okay, then we wait for a break of structure, a return, and a move up. Now let me explain this. When price approaches this point of interest, if this was to be a one hour chart, we'll move down to the 5 minutes chart. Okay, and observe the point of interest. This was the 1 hour chart. We move to the 5 minutes chart. Okay, observe the point of interest. Wait for a break of structure in that lower time frame. In this case, we have a break of structure here. We have a break of structure here. Okay, we have a break of structure here. Whenever there's a break of structure, we expect price to come back in. Okay, and then that's where we take our buy. In this case, we take our buy somewhere here. Remember, the market is fractal. What you see in a higher time frame, you see the same in a lower time frame as well. Okay, so in this case, instead of putting our stop loss below the base now, as we did in the risky method, yeah, we put the stop loss below. In this case, because we have observed a break of structure, that makes this low a protective low. I will explain that later, not in this video. So I will be confident to put my stop just below that low. Okay, in that case, it gives you a better risk to reward because your stop loss is smaller. When stop loss is smaller, your risk to reward becomes what? Bigger. Okay, so that is the confirmation. Okay, you wait for a confirmation, a break of structure in the lower time frame, and that is how to trade the supply and demand. Okay, you can do this on the flip side. In a down market, be interested in the base. The base is what we call the POI, point of interest. Okay, POI stands for what? Point of interest, and that is where we'll be observing price. It's called the point of interest because we're interested in that area to make our decision, either to buy or sell, depending if it's the demand zone or a supply zone. The supply zone, we'll be looking at the point of interest to see if you can sell the market. And I will encourage you, this is not a financial advice anyway, just my own opinion, to always wait for confirmation, especially if you're a new trader. Wait for a confirmation before you move into that trade. Confirmation is simple. It's all about waiting for a break of structure in a lower time frame. If you are observing the point of interest on the 4 hour, wait for a break of structure in the lower time frame. It could be 1 hour, it could be 15 minutes, it could be 5 minutes. Are you with me? So you wait for the break of structure before you enter. Market is fractal. The way the market moves in a higher time frame is the same way it moves in a lower time frame. So on that note, we call this video to a close. If you have any observation, if you have any comment, feel free to comment in that description. If you are new and you have not subscribed, or if you have been following this channel and you have yet to subscribe, please subscribe. Hit the subscribe button, smash the notification button, like, comment, so that YouTube will be able to boost the video more and more, because it has created what value. YouTube will boost the video more and more, and I will so much appreciate that. And so from next video, I'll be giving shout out to my subscribers. So endeavor to do that on a random basis. I can pick anyone and then give a shout out to that person. Okay, on that note, we call it a day. Bye.